This tutorial looks at the weighted average cost of capital, or WACC for short. WACC is simply just the average return needed to satisfy all capital providers. So the average return needed in order to satisfy all capital providers. And the calculation for WACC is as follows. It's the market value of equity divided by the total market value multiplied by the return required by your equity providers plus the market value of, say, your preference shares, again divided by the total market value multiplied by the return required by your preference shareholders, plus the market value of debt over the total market value multiplied by the return required by your debt providers. So the calculation of WACC involves the return required by each type of source of financing. So it's the return required by your ordinary shareholders, the return required by your preference shareholders, and the return required by your debt providers. And every return is weighted in accordance with the market value of that equity source in relation to the total market value. So the market value of equity divided by the total market value of equity, preference shares, and debt. And then the market value of your preference shares divided by the total market value, which consists of equity, preference shares, and debt. And then lastly, the market value of debt divided by the total market value of equity, preference shares, and debt. So let's say the business obtains financing with R1 million. And the business, to make this example simple, only consists of two kinds of capital: your ordinary share capital and debt financing. So of this R1 million, half of it comes from your ordinary shareholders, and they want a return of 20%. And then the other 500,000 Rand comes from your debt providers, and they want a return of 10%. Please note that the return required by your debt providers is commonly known as interest. So in order to work out what the return on the R1 million should be in order to satisfy both your equity providers, so providing them with the return of 20% that they want, as well as satisfying your debt providers, so giving them a return of 10% that they want, you need to calculate the WACC. And the WACC is calculated as follows. It's the 500,000 Rand value of your equity divided by the total value of your capital, which is R1 million. So 500,000 divided by R1 million multiplied by 20% plus the market value of debt, which is 500,000, divided by the total market value of debt and equity, which is R1 million, multiplied by the return wanted by your debt providers. This gives you 5/10 or half multiplied by 20% plus 5/10 or half again multiplied by 10%. So this gives an answer for weighted average cost of capital of 15%. So given the capital provided of R1 million, the business needs to achieve an average return of 15%. If they achieve an average return of 15%, they'll be able to satisfy both the equity providers as well as the debt providers. Let's dig deeper into the numbers and see if this makes sense. So if capital provided of R1,000,000 earns an average return of 15%, which is the weighted average cost of capital, rand. So it means the profit from the R1,000,000 capital should be 150,000. Now, does this 150,000 satisfy both the equity providers and the debt providers? Yes, it does. So of the R1,000,000 in total provided, 500,000 was provided by equity providers and they wanted a return of 20%. So on the 500,000 rand that they contributed, they wanted to be paid, or they wanted a profit of 100,000 rand. And then of the R1,000,000 provided in total again, 500,000 was provided by the debt providers and they wanted a return of 10%, which means that they wanted 50,000 rand. So the 150,000 rand, which is 15% of the entire capital provided, will allow for the equity providers to be paid, but it will also allow for the debt providers to be paid. So the weighted average cost of capital of 15% takes into account the needs of both the equity providers as well as the debt providers. It's important to note that when calculating the weighted average cost of capital, you cannot just take the returns required by the different providers of capital and work out a simple average in order to work out the weighted average cost of capital. A simple average would just be to take the 20% plus the 10% and divide it by 2. That would give you 15% and it would work in this case. The only reason it works in this case is because the amount of capital provided by your equity providers and your debt providers is equal. In the event that the value of the capital provided by the different capital providers is not equal, then you need to take the return for each source of capital and multiply it by the weight of that source of capital in relation to the capital as a whole provided to the business. In terms of the calculation for the weighted average cost of capital, there's just one adjustment that needs to be made. Remember, we said that the cost of debt is commonly known as interest. And interest is tax deductible. If you have profit, say, of 100,000 rand and no interest, then you would pay tax of 28% on this profit of 100,000 rand. So you would have an expense of 28,000 rand. However, in the event that you do have debt and therefore interest, your profit would be 100,000 rand, but you'd first need to remove interest from that profit. Let's say the interest is 10,000 rand. Your profit would then be 90,000 rand. And your tax would no longer be based on the 100,000 rand. It would be based on the 100,000 minus the interest, which is tax deductible, of 10,000, leaving you with only 90,000 rand. So the tax on the 90,000 rand would be based on 28%. So the 90,000 rand multiplied by a tax rate of 28% would give you a tax expense of 25,000 200. So in the situation where we didn't have debt and therefore didn't have interest to pay, we had a tax obligation, we had a tax expense of 28,000. But in the event where we did have debt and as a result of that had interest on that debt, our tax expense was actually reduced. It's no longer 28,000 Rand that we need to pay. We need to pay only now 25,200. So the presence of interest actually has a tax benefit. It reduces your tax expense. So now, taking this into consideration, your weighted average cost of capital is calculated as follows. It's the market value of your ordinary equity divided by the total market value of all your capital, multiplied by the return required by your ordinary shareholders, plus the market value of your preference shares divided by the total market value, and again multiplied by the return required by your preference shareholders. And then lastly, and this is where the change comes in, it's the market value of debt divided by the total market value multiplied by the return on debt, which is interest. But remember, this cost, this interest has got tax beneficial consequences. So the return on debt or the interest is multiplied by 1 minus T, which stands for the tax rate. So if the interest charge is 10%, so if the cost of debt or the interest is 10%, the eventual net cost of this debt would be equal to 10% multiplied by 1 minus the tax rate, which is 28%. So the ultimate cost of your debt would not be 10%. It would be the cost of 10% reduced by the tax saving property of interest. So therefore your ultimate cost of debt would not be 10%, but would be 7.2%. So the return on equity is weighted in accordance with how much of that equity you have in relation to the total equity. The return on your preference shares also weighted in accordance with how much you have as preference shares in relation to the total capital provided. And the return on debt is also weighted in accordance with the value of that debt in relation to the total value of all capital provided. But with debt, we go a little bit further by incorporating the fact that debt has got tax saving properties.